Last year, Michael Burry told us that he believed a mother of all crashes was coming to the stock market. And just a few months later, it started to crumble. Now, we're near the end of 2022 with the S&P 500 down 15% from its peak. And the man famous for shorting the housing market right before it collapsed in 2008 tweeted that he is no longer short. And this is pretty big news for Burry because as recently as this year, he has held short positions where he's bet against either broadly the market or individual companies. So today, I want to discuss what this tweet and his other related ones mean, as well as take a look at some of the new stocks that he bought in the recent quarter, and ultimately what it all means for the average investor like you or me. Michael Burry is worth listening to because he brings unique insights about the economy and helps average investors to understand the mechanisms of how the economy functions. And while he does make a lot of predictions, many of which are wrong and are just kind of forgotten about, recently he's been bang on about a lot of things. The most recent one is his prediction around the cryptocurrency space. 2021, he tweeted that the problem with crypto was leverage, and we've certainly seen how that's worked out over the past few weeks. But Burry's predictions shouldn't be about us trying to time the market or really make any financial decisions, but more about observing what is happening just to deepen our understanding of how the market functions. Burry's most recent tweet simply states, "I am not short." And while this is relatively simple, I think there's quite a bit we can unpack from it. Shorting or going short in finance essentially means that you're betting against the performance of a stock or some other kind of security. It's essentially the opposite of going long on a stock, which is simply where you buy the stock and if it goes up in price, you can sell it for higher than you bought it. Going short is where you sell the stock first, and then if the price declines, you're able to buy it back at a lower price, essentially benefiting from the stock price declining. And hearing that, you might think, how on earth do you sell the stock first and then buy it back later? Well, you borrow the share from somebody, you sell it in the market and receive some money, and if the stock price declines, you're able to buy the stock back and return the stock to the lender. And Burry stating that he is not short does reflect a shift from last year where he did hold quite a few short positions. Now, unfortunately, Burry doesn't have to disclose traditional short positions in the way that I just described it, but what he does have to report is shorting done through put option contracts, which is a form of derivative, which is kind of a different way that you can short or bet against stocks or the market. Instead of borrowing shares from somebody, a put option contract essentially gives you the option to sell shares at a fixed price in the future. So if you hold one of these contracts and the share price declines, you're able to buy the stock at a lower price and then sell it at a higher fixed price through the contract. And Burry used these kinds of contracts a few times throughout 2021. The most notable was buying 20,000 put option contracts on 20-year US Treasury bonds. Essentially, Burry was betting that inflation would continue to get worse, that the Federal Reserve would need to raise interest rates, and those higher interest rates would cause bond prices to decline. And while he was a little bit early making this bet in the middle of 2021, he essentially was right in terms of what happened and the mechanisms that followed through. As of the latest 13F SEC filing, which outlines his US stock holdings, Burry no longer holds any put option contract bets. And with his latest tweet saying, "I am not short," I think it's reasonable to assume that he no longer holds any direct short positions either. So does this mean that the mother of all crashes is over, that the market's just going to go up from here? Well, not necessarily. The market has come down this year, but it's nowhere near the great speculative bubble bursting that Burry has been warning about. The price of stocks broadly when compared to earnings of companies has improved significantly this year, but you can see the ratio is still about 33% higher than the long run average. So if interest rates continue to rise and approach the long run average, and the earnings of companies in the S&P 500 are stable or even maybe decline, then you would expect there's quite a bit more of a decline in the stock market to come. I don't think we should read into Burry's tweet as saying that the recession or the stock market crash is over, but more that he's just no longer making a broad bet on where the economy will go. After all, I don't have any short positions, but that doesn't mean that I'm making a bet that the market crash is over. I have no idea what the market is going to do in the short term, and I don't need to know because I'm betting on individual companies. And it looks like Burry is doing the same thing. His latest 13F filing revealed a number of new stock positions which he discussed in a series of tweets. And we can use the sponsor of today's video to take a look at what positions are in Burry's portfolio. TIKR is a fantastic financial tool that has a ton of useful features, including being able to track fund manager investments. In this case, we're taking a look at Michael Burry's firm, Scion Asset Management. We can see which stocks are held by the firm, what are their current value and percentage of the portfolio, as well as whether they are new positions or adding to or reducing existing ones. The best thing about TIKR is that not only does it grab 13F data, which shows us US holdings, but it also grabs data from other countries to give us a fuller picture of investor portfolios. For example, Burry has some investments in Japanese companies, and since he's holding more than 5% of the company shares, it's disclosed and we can see it in TIKR. I never just blindly copy these super investors, but I do like to look at their portfolios to potentially farm ideas that I go on and research further. If an investor I respect, such as Michael Burry, invests in a new stock, I can quickly go over to TIKR and start searching up some basic checks to decide whether I want to shortlist that stock for further research. Some of those things include looking for growing revenue, earnings per share, equity, and free cash flow, looking for companies with a current ratio above 1 and a debt to equity ratio below 1, and of course a company that consistently generates high returns on capital. I can also use TIKR to check valuation ratios, analyst expectations, and access conference calls and other company filings. If you use my link and sign up to an annual plan, you'll currently get more than 40% off, or you can just sign up to a free plan. Either way, use my link and let TIKR know that I sent you. At the end of the previous quarter, Burry only had 1 US equity. Now he has 6. He increased his bet on Geo Group by 300% and initiated positions in Qurate Retail, CoreCivic, Aerojet, Charter Communications, and Liberty Latin America. He also slightly reduced his investment in 3 Japanese companies, although they reflect relatively smaller bets than some of his other positions. The basket of stocks that Burry has in his portfolio are all very different, and I have a hard time figuring out what the thesis is for some of those bets. But before the 13F filing was released, Burry explained his reasoning behind at least some of these bets. He said, low price to cash flow businesses are different today versus 2000 because they will buy back stock, buy back debt at a discount, and in general manage capital structure better, makes them statistical value math problems that more or less work out. He went on to say, companies that are heavily leveraged but have the cash flow and termed out debt have options today, including reducing their debt loads at a significant discount brought on by higher interest rates. But as Graham said, in such a case, better off buying the stock. Businesses that have really weak cash flows and high debts are in the worst situation right now because rising interest rates simply means that these businesses that are already cash poor will continue to see the cost of their debt rise. But if a company has high debts and is very cash flow positive, then higher interest rates essentially just gives those businesses the opportunity to retire that debt at a discount. As interest rates rise, the prices of older bonds with lower interest rates will decline, and that essentially means a company can just use their cash flow to repurchase those bonds at a discount. And it works pretty similarly to a company repurchasing their own stock. As interest rates rise, it's pretty typical for stock prices to fall. And if a company has a lot of cash flow, they're able to use that to repurchase their stock while it's undervalued. Both repurchasing debt and stock while it's undervalued drives more value for shareholders. But Burry follows Benjamin Graham's logic that even in these cases, it's better for the company to repurchase their own stock. One stock in Burry's portfolio which seems to fit this description is Qurate Retail Group. Qurate Retail sells consumer products via live television shopping programs. The company has stable revenue, stable operating income, and pretty stable free cash flow. It also has about $7 billion in debt and trades at just 10 times next year's free cash flow. Plus, up until 2018, the company was basically using all of its free cash flow to repurchase its own stock, and that rate has only slowed in the last couple of years while earnings have taken a hit. So given the tweets he made at the end of the quarter, as well as this bet, it looks very much like he's found a relatively stable company with a history of doing aggressive share repurchases and is trading at a relatively low price to its free cash flow. These types of bets are pretty typical for Michael Burry, and they essentially reflect classic value investing that was laid out by Benjamin Graham almost 100 years ago. These principles are sound, and many investors have used them in the past and even now to generate significant returns in their portfolios. But personally, I tend to gravitate more towards more modern value investing principles laid out by the likes of Charlie Munger and Warren Buffett, which essentially means I'm focusing more on high quality businesses rather than just simply investing in companies because they're very, very cheap. But regardless, there's something more interesting in Burry's portfolio than these individual companies. Of the US and Japanese stocks that we can see in TIKR, they only account for about $70 million of the almost $300 million that he has of assets under management. That essentially means that the vast majority of Burry's portfolio is unknown to us. It could be that he has cash, but more likely it's probably that he has a lot of bets in international markets where we don't get to see the SEC filings, or where he doesn't own enough of the company for it to be reported by the company. Or, of course, it could mean that he has short positions, but given his tweet, I think that's fairly unlikely unless he's just flat out lying on Twitter. But ultimately, this is interesting to me because it's a really good example of why you can't just copy institutional investors. not only are 13F filings 45 days late, we don't really get the full picture. And in this case, we're only getting a relatively small slice of BURRY'S overall portfolio. It's better to use institutional investor portfolios as potentially places to farm ideas that we can do further research on, rather than using them to make your own investment decisions. And this is particularly the case with something like Michael Burry's portfolio, where he's placing a large amount of small bets in the US and outside of the US. And most of these are probably going to fail. He only needs a few of these to do extremely well for the whole portfolio to do well. So if you're just going to copy one or two of Michael Burry's bets, more than likely you're going to fail. Beyond his stock holdings, Burry has also been tweeting about the economy again. He said 156 years ago seems a lot less long ago at 51, and then followed up with an explanation. 156 years ago was a market panic in England that led to the creation of the first modern style central bank, paving the way for the Fed and for our absolute dependence on every word of its chairman. It has always been about plunge protection. And Burry here is simply pointing out one of the major negative side effects of the current financial system we have, with a central bank that can move markets so significantly very quickly. Whatever Jerome Powell of the Fed says is often reflected immediately in the markets. Just this week, Powell stated that smaller interest rate hikes are likely going to be needed going forward, and on that news, the Nasdaq went up 4.4% in a day, with stocks like Tesla and Netflix up 8% each on the day. And it makes absolutely no sense that a small statement like this by the Fed would have such a dramatic impact on the markets immediately. Yes, it is true that future interest rates will have an impact on how stocks are priced, but to think that Jerome Powell knows what future interest rates will be is laughable. Nobody knows what future interest rates are going to be. I mean, even 12 months ago, Jerome Powell still thought that inflation was transitory. And fast forward 12 months, interest rates are now 3 times higher than they expected back then. So if they were so wrong over the past 12 months, why should their expectations for the next 12 months on interest rates or inflation have any impact on our investment decisions? So instead of doing what Wall Street does, which is they pay super close attention to what the Fed says, and then if there's a slight change in interest rate expectations, they adjust their models, adjust their valuations, and sell a bunch of stocks or buy a bunch of stocks based on those tiny little adjustments. Instead of doing that, I just use a fixed discount rate in my own valuations. I target 15%, and that way I have a discount rate in my valuations that works pretty much regardless of what interest rates do. If I'm using a 15% discount rate, unless bond rates get close to or above 15%, where I can essentially buy a government bond and make 15% with a lot less risk, then I'm happy to continue buying stocks using my models. And yes, if I'm using a discount rate of 15% and rates stay very low, then there will be very little investment opportunities in the markets, but that's okay. I don't need many investment opportunities. I can make very few critical decisions over a couple of decades and still do very well in the markets. And the thing is, even when interest rates are low and the stock market is surging and doing very well, there's always occasionally opportunities where a particular business or a bunch of businesses or maybe an industry face some kind of short-term problem, which means that the stock can be purchased at a low price and I can earn 15% on that stock, even though broadly the market may earn a lot less. Essentially what I'm saying here is that Wall Street and institutional investors are so sensitive about what their discount rate is, and the result of that is they basically just mimic the market, and then you minus their fees and they do worse than the market. Whereas if you can be a little bit more patient, a little bit more strategic, then you can just look for the unique opportunities where you can still make a very high return on a relatively safe or high quality business. Quick reminder to check out TIKR and get up to 40% off an annual subscription if you use my link down in the description below, or you can check out their free plan and use it for as long as you want. With that said, hope you enjoyed this video. I'll see you in the next one.